Okay. So we'll start with the 2011 A-levels question number 4. So this is the question that comes from unit number 5. Okay. Now, some of these questions, guys, in your A-level answer scheme, the answers might be outdated because, like I said earlier, the way you calculate national income accounting changed by around 2015, 2016. During that period, it changed. So now what I will do is, right, you might have different answers in your actual marking scheme. I will give you the latest answers that is there. Okay. So we'll start. Starting off with this question. What are the categories? Where is the question? Sorry. Question is gone. Question. Okay. This is the question. Okay. What are the categories of income? What categories of incomes are included in the income approach of calculating GDP? Now, probably in your A-level past paper, this would say rent, wages, interest, profit. It would have things like that. But now we'll change this question a little. So we'll talk about what are the components in the income approach. Can you all give me the components quickly, guys? What are the components that we have when we calculate GDP using the income approach? What do we have? So we have number one, compensation of employees. So inside compensation of employees, what kind of things do we have? Inside compensation of employees is just additional information for you all. You might have the basic salary. You might have bonuses that the employees get. You have the social security contribution. Now you all know something like EPF, the employer also contributes some part, right? Now you all know it's 8% employee, 12% employer. There is like a contribution that goes. That also comes under compensation of employees. So then maybe any insurance benefits that they get, yeah, different things comes under this. What else? After compensation of employees, what do you have? You have gross operating surplus. So what is gross operating surplus? Gross operating surplus is ideally the income of businesses. It's like their profit. So what do we have inside gross operating surplus? We have net operating surplus. We have consumption of fixed capital. This is also called depreciation. And also, guys, you can put mixed income also into this. What is mixed income? Mixed income is the profit of these small businesses, the unregistered ones, like, let's say a small grocery shop, let's say a small vade kade, those profits, those people's incomes are called mixed income. What is the other component? You have other taxes less subsidies on production. So what are these other taxes less subsidies? These are things like, taxes on the property, taxes on motor vehicles, taxes on emission, yeah, those kind of taxes. Can you all tell me, guys, if I add all of this, do I get GDP or do I get something else? What do I get? If I add compensation of employees, gross operating surplus, and other taxes less subsidies on production, what do I get? When I add these three main components, what's it called? Quickly, guys, now you all should know. This is gross value added at what price? Gross value added at this. When you add all of these three, guys, remember, we get gross value added at basic price. To this, if you add what, do you get GDP at market price? What do you need to add to get GDP at market price? If I add what? If I add net taxes on products, net taxes on products and imports. So usually imports are not there. So we usually say net taxes on products. But in case they have given net taxes on imports, remember, you need to add that as well. But usually in questions, taxes on imports are not there. That is why we just simply add net taxes on products. Okay. So these are the components of the income approach. Now, this might not be the answer, I'm repeating. This might not be the answer in your marking scheme because this is the 2011 paper. I don't know what your marking scheme says, but your marking scheme might most likely say something like rent, wages, interest, and profit. Okay. Now, so with that, we'll move to the next question. Question 2. How does the problem of double counting arise in calculating GDP? And how is it corrected? Explain your answer with an example. So what is this double counting error? Double counting error is where you include something called intermediate goods also when calculating GDP. So let's take a small example. We'll take an example of what? Okay, we'll take an example of okay, let's say a garment manufacturer will, right? We'll take an example of someone producing clothes, garments. Okay, let's say t-shirts. So there is, let's say, a farmer, okay, a farmer who is producing cotton, right? So there is a farmer who produces cotton. This is the first person. What does this do? This guy is the cotton producer. So let's say cotton, I think cotton comes from all these trees, no? Okay. So this farmer, without any intermediate consumption, let's say, he produces an output of, for example, let's say an output of 10,000. The farmer who is producing cotton produces an output of cotton of 10,000. Then what does this farmer do? This farmer who produces the cotton, he might sell this cotton to a producer who produces cloth, right? Or in other words, let's say fabric. Okay. So this cotton producer will sell off all of his cotton that he gets to another guy, right? To another producer who produces what? Who produces cloth, or we'll call it fabric. Okay, we'll call this guy the fabric producer. So the fabric producer, using this cotton of 10,000, that is his intermediate consumption, using this cotton of 10,000, let's say he produces an output, right? He uses the cotton, he puts it into his machine, he does different things, and let's say at the end, he gets nice plain cloth, okay, sheets of cloth. His output, let's say, is 25,000. Then what does the fabric producer do? The fabric producer sells his fabric, in other words, plain sheets of cloth. Let's say he sells this to a textile manufacturer, okay, someone who is producing t-shirts. Okay, so this textile manufacturer, what does he do? Now this is the textile manufacturer. So the textile manufacturer, what does he do? He uses this cloth, he sews the things, put the buttons, right, the thread, and does all of it, and he produces, let's say, t-shirt. So this textile manufacturer uses intermediate inputs or intermediate consumption of 25,000 worth of fabric, and he produces an output of, let's say, 50,000. What does the textile manufacturer do? The textile manufacturer, now textile manufacturer doesn't sell textiles in his factory, no. So he will now transfer it to, let's say, somewhere like No Limit. Okay, he transfers it to the retailers. No Limit, Fashion Bug, Odell, Candy, this fashion, that fashion. What does he do? He transfers all of this to the retailer. So let's say someone like No Limit or someone there. So what does the retailer do? Right, we'll just say within brackets No Limit. I think everyone knows No Limit. Okay, so he sells it to No Limit. Now retailer, now he will also keep a small profit and everything. He is also displaying the goods. He's also, you know, nicely keeping it, providing an air conditioned environment for the customers to come and look at the goods. So there is a value addition there. Fit on rooms, right? Everything is there. So this person uses intermediate inputs of 50,000 and sells the cloth, or sells, let's say, the t-shirts, which is the output, for, let's say, a 60,000. Now I'm trying to teach you double counting. Okay, so what happens over here? Now when you calculate GDP, what is GDP? GDP is the value of all the final goods and services produced during a year. Now let's say the person calculating GDP, he goes and asks the cotton farm, Cotton farmer says, look here, sir, I produced 10,000 worth of output. Right. So this fellow makes a note, 10,000. Then the person goes and, okay, so let's say cotton guy says, okay, I produced the output worth 10,000. Okay, so he has made a small note. Then the person who is calculating GDP goes to fabric producer. Fabric producer says, sir, look here, mama, right, I made a output of 25,000, right? So he has recorded that as well. Then this guy goes to textile manufacturer. Let's say someone like MAS or some garment factory. Textile manufacturer says, look here, I produced the output, or my final output is 50,000. Fine. Then he goes to the retail halls, the final guy. The retailer says, sir, my output is a 60,000. Right. So now the person who is calculating GDP, let's say a government official, so he has gone and got the goods produced by each of these people. Now he adds all of this, right? 10,000 plus 25,000 plus 50,000 plus 60,000. And then he says, right, cotton fellow produced 10,000 goods, fabric producer 25,000, textile producer 50,000. So likewise, he adds all of this and says, okay, that means the GDP of Sri Lanka or GDP of the country has to be the addition of all of this. How much is that? 60 plus 50, 110, 110 plus 35, 145,000. Is this correct? Is this correct? If you say the GDP is 145,000, this is not correct. Why? This is what you call the double counting error. How is this the double counting error? Oh, we can call this the multiple counting error. What you need to know, guys, is this 10,000 of output, this 10,000 of cotton is already inside this 25,000. This 10,000 of cotton is already inside the cloth, no? It's already inside that. This 25,000 of cotton is already inside this 50,000 of t-shirts produced. This 50,000 of t-shirts produced is already inside this 60,000 worth of final output the retailer is selling. So when you add all the outputs, then what happens? Then you end up double counting it. You end up counting the same thing a multiple number of times. And as a result, your GDP can be overestimated. So how can now, that is what you call the double counting error. So I'm not going to give you a typed answer, guys. You all can look at the textbook. So what is double counting error? The double counting error is where when calculating GDP, the production of intermediate inputs or the production of intermediate goods are also included in GDP. As a result, GDP becomes overestimated. So how can it be corrected? What are the two approaches, guys, to correct this? I'll put this on top. How can you correct the double counting error? There are two ways. How many of you all remember this? What are the two ways of correcting the double counting method error? So one way to correct this is we use the final product approach. What is the final product approach? So to correct this double counting error, we ignore all the other stages. And what do? We consider only the final good. So what is our final good? This one, right? The output of 60,000. So in this output of 60,000, this 50 is also there. This 25 is also there. This 10 is also there. Everything is included, right? Because this 10 is there in this 25. This 25 is there in this 50. This 50 is there inside the 60. So it's already inside, no? So therefore, you ignore everything else and you only consider what, guys? You only consider the final good. That is one way of avoiding the double counting error. Because otherwise, what is double counting once again? The double counting or the multiple counting error is where when calculating GDP, you include intermediate consumption also. You include intermediate products. The same product then gets included twice, because if you include cotton 10,000, that cotton is there inside the fabric output also. So you're including it multiple times. That's what you call the double counting. So to avoid it, one thing you can do is you can take the value of the final product only. Is that clear, guys? That's the final product approach. Then what's the second approach? The second approach. The second approach is the value added approach. So in the value added approach, what do you do? In the value added approach, you calculate the value added at each and every stage of production. What is value added? We'll think is, can you tell me this farmer, without using any inputs, now he is having trees, no? So let's say he is not using any inputs. Without any inputs, he is producing an output of 10,000. So how much is this farmer's value addition, guys? How much is the farmer's value addition? From trees, he is getting all the cotton and everything. Is it zero or is it something else? How much is value addition? With zero inputs, he's producing an output of 10,000. So his value addition, guys, is a 10,000. It's not zero. How do you get value addition? Gross value of output, the 10,000 minus your input. So 10,000 minus a zero. So 10,000 minus zero is 10,000. Value addition 10,000. Then how much is the fabric producer's value addition, guys? Can you give me a number? What do you all think? The fabric producer. Fabric producer is producing an output of 25,000. But to produce that output of 25,000, he is using 15,000 of intermediate consumption. So how much is his value addition? What is the new value that he is adding? So 25 minus a 15, he is adding new value of, 25 minus 10, he is making a contribution of how much? He is making a contribution of 15,000. Then can you quickly tell me how much is the textile manufacturer adding? Textile manufacturer is producing an output of 25, but he is also consuming inputs of another 25. So how much is his value addition? His value addition is 25,000. What is the value addition of the final retailer? Retailer is also displaying the goods, AC environment, fit-on rooms, all of that. He's also doing a value addition. How much is his value addition? That's a 10,000, 60 minus a 50. So according to the value added approach, what do you do? How do you calculate the GDP? You add all these 10,000, right? You add the 10,000, the 15,000, the 25,000, and also the 10,000. So how much do you get if you add all of this? 10 plus 15 plus 25 plus 10. How much are we getting? We're getting still the same answer, right? We're still getting how much? We're still getting 60,000. So whether you use the final product approach or whether you use the value added approach, the final answer that you get can't change. It has to be the same. Is that clear, guys? So this is how you calculate the GDP. When you add all of this, you get GVA, right? We'll talk about GDP later. So when you add all of this, you get the gross value added of the total production without including all intermediate inputs. Is that clear, guys? Guys, I'm not teaching this for the first time, okay? You all would have learned this in your theory revision classes. I'm just recapping. Okay, I'm hoping that's clear. And can you all tell me, from these two approaches also, which one is the better one? The final product approach or the value added approach? Which one is the better one? The value added approach is the better one. Why is that? Why do we say the value added approach is a better approach than the final product approach? Both are giving the same answer, right? At the end of the day. So how is the value added approach better than the first one? What's the reason? The reason, guys, in the final product approach, sometimes we can't find out whether a good is a final good or not. For example, remember the example I gave in my classes, Mari biscuit. Now, if I ask you, is Mari biscuit, now let's say there is a producer who is producing, let's say, I know, how do you produce biscuits? Flour, right? So, guy producing flour. The flour guy does something else, something. And the final, in the Melbourne factory, there is the Marie biscuit. So I'm asking you, is this Marie biscuit a final product or not? Now, it would have been a final product if you bought it and ate it. If this Marie biscuit was used to, let's say, make biscuit pudding, then this would also be an intermediate input. So there are some goods you can't clearly identify whether it's a final good or an intermediate good. So therefore, the final product approach also is kind of flawed. It's kind of, not ideal, because you can't identify whether a product is actually a final product or not. Therefore, the best approach out of even these two, what is the best approach? It's the value added approach, which is the better one. So that is about value addition, right? And how you get all of that done. Is that okay? Fine. Okay, we'll move to the next. Okay, this question says, the following is the information from the national income accounts of a hypothetical open economy. Assume that all taxes are direct taxes and there are no subsidies. So what are direct taxes? Direct taxes means they are income tax, no? Income tax is a direct tax. So these are not excise duties or VAT or things like that, not those. These are direct taxes, okay? Calculate the following: net domestic product, net exports, net taxes, disposable personal income, personal savings. So they're giving you 5 marks for 5 calculations. We'll try to calculate one by one. How do we get? Okay. First of all, guys, when you get a GDP calculation from unit number 5, the first thing you have to do is figure out which approach are you going to use. So there is the output approach, there is the income, and there is the expenditure approach. So from the 3 approaches, you need to figure out which approach am I going to use to calculate GDP. Okay. So look at this information and tell me, guys, there is GDP given. There is already GDP. You don't even have to do it. Gross investment, net investment, private consumption, government purchase. Yes, just look at this and tell me which approach is this. Look at the at least the components and tell me this is the expenditure approach. No, this has that. Fine. So then, guys, how do I calculate net domestic product? Net domestic product. From gross domestic product, if I minus consumption of fixed capital, that is what? CFC, then I can get, right, net domestic product. So from GDP, if I minus consumption of fixed capital, I can get net domestic product. Now, how much is my GDP in my question? 6,000. How much is my CFC? They have not given that. No, they have not. In the question, they haven't given us depreciation or consumption of fixed capital. How are you going to figure out that? Remember this. Remember the difference between gross investment and net investment. So from gross investment, if you minus CFC, what do you get? Net investment. So in our question, they have given us gross investment. They are saying gross investment is how much? Gross investment they are saying is 800. So from 800, if you minus CFC, you get net investment. That is 200. So then can you tell me, guys, how much should my CFC value be? From 800, if I minus something, within 200. So how much is CFC? CFC is a 600. So this can be your workings, right? You can show this on the side. So CFC is 600. Can you quickly give me answers, guys? Then how much is my net domestic product? Net domestic product is a 5,400. Guys, I'm hoping you all know these components, okay? I'm not teaching you the equations and all the first time. And by now, if you're learning this for the first time, you're going a little behind, because you all know now A-levels is happening at the end of November. The date is fixed. I did give you all a plan also in the fast track, right? What to do. So you all know when A-levels is happening. So it's not going to get postponed even more and more and more. Means you have around 5 months from now onwards, 5 months or even lesser than 5 months now. So make sure that you level up. Okay. Second one, Net exports. How do we find net exports, guys? What can we do? Net exports. Remember, right, net exports is export minus imports. Fine. But do we have exports and imports here to find net exports? Remember, our GDE, gross domestic expenditure, plus net exports equals GDP. Yeah. So what is GDE? GDE is consumption, investment, and government spending. That is GDE. So that plus net exports is equal to GDP. So tell me, private consumption is 4,000. Guys, investment, which investment do we take? Gross or net? For the investment value, do I take gross investment 800? Do I take net investment 200? Remember, you take gross investment because you're calculating gross domestic product. You have to include consumption of fixed capital. So that's a 800. How much is government purchases? 1,100 plus net exports is equal to the GDP of how much? GDP of 6,000. So I'm not going to do the maths for you all, guys. Can you all move things around and tell me how much is net exports? So I don't have to teach you all maths now. Yeah, net exports is 100. Okay, right. So I'm guessing it's a plus 100. So I'm going with the answers on chat box, guys. I did not do the maths. Okay, the third one. Third one is saying net taxes. How are you going to find this? Part C, net taxes. They have given us the budget surplus. They have given us government purchases. You should be able to find net taxes here. How do you think you find? Remember, the government's budget balance, I'll just say GBB, okay? Government's budget balance is your income taxes minus the government purchases, right? Income minus expenditure. So they have a budget balance of 30 plus 30. Why? Because they are saying there is a budget surplus. Now, if they say budget deficit, I will say minus 30. But here they are saying there's a budget surplus of 30. So I'll say plus 30. So how much is my taxes? That's what I'm trying to find. Government purchases are how much? 1,100. So can you move things around and tell me how much is my taxes? Or my net taxes? What's the number? Do the maths quickly. How much is net taxes? 1,100. That's how you do that. Then part D, disposable personal income. Disposable personal income. Okay, right. GDP is what you call your national income. How much is that? 6,000. Can you tell me from GDP, that is national income, how do you go to personal income? Remember, I taught you all, right, when we did the MCQs also last week, there are few things that you have to add, few things that you have to deduct. What are the things that you add? You add things like, let's say, social security benefits. You add transfers like pensions and samurdhi benefits. You add things like government interest income that people might receive, things like that. What do you minus? You minus social security contribution. You minus consumption of fixed capital. You minus government income. You minus things like retained profit. And then you can get personal income. Now in this question, do we have all of that? We don't have all of that. We have like just one from all those what I told you. What is the one that we have? To go from GDP, that is national income, to personal income. What's the one that we have? The only thing that we have here is consumption of fixed capital, depreciation. All the others are zero. So there is no social security contribution, no pensions, nothing like that. So the only thing we have is CFC. Do we add CFC or do we deduct CFC to get to personal income? From national income, we need to deduct. We need to minus consumption of fixed capital. How much is that? That is a 600. We found it before. So then we get personal income. Personal income here is 5,400. Now, our question is not asking personal income. They are asking for disposable personal income. How do I go from personal income to disposable personal income? How do we do that? Disposable personal income. No. If it's savings, you can reduce consumption. If they are from personal income, if they ask for personal savings, then from the 6,400, 5,400, I'll deduct consumption. They are not asking you for saving. They are asking you for disposable personal income. What do you do, guys? You need to minus direct taxes. Direct taxes means income taxes. So can you see in the question, they are telling you all the taxes are direct taxes. So taxes that you find over here, the 1,130, all of this is direct tax, which means income tax. So from our 5,400, we minus direct taxes. So in our example, it's the whole thing. How much is that? 1,130. So how much do I get, guys, then? If I minus 1,130, how much do I get? 4,270. So that is my what? That is my personal income. So can you tell me, guys, if my personal income is 4,270, right now, personal income 4,270, how much is my personal saving? Disposable personal income is 4,270. From 4,270, if you minus private consumption, you get personal savings. So I'll put this on top here since I don't have space. I'll just put it on here. Okay. So how much is our disposable personal income? That's a 4,270. From this 4,270, if I minus what? Private consumption, I'll just say PC. If I minus this 4,000, I get what? The dash coming here. Minus this, I get personal. I don't have much space, but I'll just say personal this thing. That is a 270. Is that clear, guys? How I got to this? This is the last one. This is E. So how many of you all got all 5 of this correct? A, B, C, D, E without looking at the answer. Got all 5 of this correct. If you've got all 5 of this correct, that means you are actually at a good level. Because this is not that of an easy question. Okay. So there was a question in chat box. So why do we deduct CFC to get to personal income? Now, this comes from the equation. Remember, from national income, when you're going to personal income, there are a lot of things that you need to add. There are a lot of things that you need to minus. So go back to your tute. It's there in my tute as well. If you are my student, okay, just check. It should be there in any tute that you all study. Okay. So in our question, none of that is there. Yes, personal income should be calculated from GNI. So GNI is the national income. But do we have what? Net foreign income? Net primary income? We don't, right? So if there is no net primary income, GDP and GNI is the same. Do you agree with me there? If the question has not given you net primary income, then there is no difference between GDE and GNI, right? GDP and GNI. So GDP or even GNI here is the same. Why? Because there is no net primary income in our question. So then you can take the GDP number as national income. From this, there are a lot of things that you need to add, like pensions, other transfers, government interest incomes, like the interest income that people receive. Like there are so many things. Then there are so many things that you have to deduct. Then one of that what you deduct is only consumption of fixed capital. So everything else is not given in our question. That means those are not there. That is why I'm only deducting CFC. actually go and check the equation in your tute, right? We did this earlier also, right? Remember in a MCQ, I showed you all what and what we add, what and what we minus. A few weeks ago, we did this, right? So go and watch the recording if you have missed it. It's there. Then you get personal income, and that's how you get the answer. Is that okay, guys? Any questions? Anything else? So I'll just highlight the final answers. This, 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 and this. Okay, good question. We'll move to the next. Okay, explain the usefulness of compiling national income accounting statistics for a country. Yes, why does a country calculate all these national income statistics, GDP and all of it? Can you give me some points? Is personal savings and domestic savings the same? Not really. Domestic savings is investment plus net exports. Personal savings is different. Okay. Can you give me this thing, guys? Usefulness of compiling national income, right? So you can say, you can give me answers on the chat box. Until you all give me answers on the chat box, I'll just get it from my tute itself without wasting time to type. Others, guys, at least give me one usefulness. Come on. It's a 6-mark, 5-mark question, right? To measure economic growth, to make comparisons with previous years, right? Good. Anything else? Okay. Yep. So I'll here are a few things that's there in my tute as well, guys. Okay. The importance of national income accounting. I'll copy this and I'll paste it in the answer. Okay. So why is this useful? It's useful for all of these reasons over here. Okay. So to measure economic growth, to calculate per capita GDP, to look at the structural characteristics like how much is for agriculture, how much is for industry, how much is for service, you know. So for all those reasons. Now, since they're asking you to explain, you can't give it in point form like this. You need to write paragraphs. So please convert this into a paragraph and nicely write your answer. Okay. That is the last question there. So how is the question, guys? If you all are to mark your answer, how much do you think you would have got? Categories of income, part 1, double counting error, part 2, the calculation, part 3, and the last one, usefulness of compiling national income account. I think you could have easily got a 15, right? Don't you think? Out of 20? Could have easily got 15 or more. Okay. So with that, we'll end the 2011 one. We'll move to 2012.